If I told you there was a company out there, just bending metal, machining physical parts, and operating these actual physical assembly lines, but they somehow managed to pull off software level profit margins of 52%, you'd probably tell me my math is broken.
I mean, yeah, I would. You expect those kinds of numbers from a SaaS company, right? Like somebody licensing code out in Silicon Valley.
Exactly. Not from some traditional industrial manufacturer making aerospace components, yet here we are. So today, our mission is to unpack the Q1 2026 earnings call for TransDigm Group.
Ticker symbol TDG. For those following along.
Right, TDG. And welcome to a special Talk Tickers format deep dive. Because look, if you're building and managing your own portfolio, navigating the aerospace supply chain, and all the dense financial engineering of these aerospace conglomerates, it can honestly feel like trying to read a foreign language in the dark.
Yeah, it's incredibly opaque.
It really is.
Yeah.
So we are going to strip all of that away today. We are heavily focused on the raw data, the underlying strategic story that's actually moving those numbers, and management's specific guidance for the rest of fiscal 2026.
And of course, the bottom line for your capital allocation, what it actually means for your money.
Exactly. So let's just jump right in. What are we actually looking at here with TransDigm?
Well, we are looking at a business model that is... it's structurally unique in the industrial landscape. TransDigm is not your traditional aerospace prime.
Right.
Like they aren't assembling massive commercial jets in these sprawling hangars. The best way to visualize their operation, I think, is to think of them as a publicly traded private equity firm.
Oh, that's a great way to frame it.
Yeah, but a private equity firm that has somehow managed to construct this highly lucrative toll booth right in the middle of the global aerospace highway.
A toll booth. I love that.
Right. They acquire, they optimize, and they hold this massive portfolio of highly specialized manufacturing units, and they just run them with this absolute ruthless focus on cash generation.
So let's contextualize that toll booth analogy for the listener, because it's really the lens through which every single piece of data today needs to be viewed.
It really is.
So TransDigm owns over 50 decentralized operating units. And actually, based on the aggressive moves they outlined on this call, they're rapidly approaching 56.
Yeah, they've been busy.
Very busy. But the defining characteristic of this portfolio, the thing you have to understand, is that roughly 90% of their total sales come from unique proprietary aerospace products.
Proprietary being the key word there.
Exactly. We are talking about highly engineered mission-critical components, things like specialized pumps, complex valves, electromechanical actuators, ruggedized ignition systems.
Basically the unsung invisible parts, right? The
Yeah.
stuff that commercial and military airframes absolutely require to operate safely.
Right. To maintain their airworthiness certification, you literally can't fly without them. And because these parts are deeply proprietary, TransDigm essentially holds the intellectual property keys.
Yep.
So when an airline or a maintenance facility needs to replace that specific valve, they don't have a marketplace of a dozen vendors to, shop around for the best price.
You really don't. They have to pay the toll.
They have to pay the toll. They have to buy it from TransDigm.
And that proprietary moat, that's the foundation, right? But the true velocity of their cash flow, it really comes from how heavily weighted they are toward the commercial aftermarket.
Let's break that down.
Sure. So in the aerospace sector, the initial sale of a component to an OEM, an original equipment manufacturer like Boeing or Airbus, that initial sale is frequently priced at a much lower margin.
Because they just want to get on the plane.
Exactly. In some competitive bidding scenarios across the industry, suppliers will actually take a loss on that initial OEM installation just to secure their position on the airframe.
Wow, so they lose money on day one.
Right, but the economic payoff happens over the subsequent, 20 to 30 years of that aircraft's operational lifespan.
Because things break.
Because things break. Those mechanical components inevitably endure intense thermal and physical stress. They wear out. They require scheduled maintenance. They need overhauls. They need full replacement.
Right.
And that replacement cycle, that is the aftermarket. And it basically operates on razor and blades economics, but scaled up to multi-million-dollar aviation assets.
Yeah, so you take a loss on the razor handle to lock them in, and then you just sell them the high-margin blades for the next 3 decades.
That's exactly it.
Every time an airline pulls a plane into a hangar for a heavy maintenance check, that toll booth registers a transaction. It's brilliant.
It really is a machine.
So, keeping that economic engine in mind, let's look at the headline numbers from this Q1 2026 call, because honestly, they are incredibly robust.
Let's hear them.
So, Organic growth came in at 7.4%. Total commercial OEM revenue jumped 17%. And if we isolate just the commercial transport OEM, stripping out the smaller business jet segment, that actually hit 18%.
Which is huge.
It is. Those are really aggressive top-line growth figures for a company of this scale.
They are, and top-line revenue growth is a great indicator of end market health. But with TransDigm, their valuation is entirely predicated on their profitability metrics.
Right. It always comes back to the margins.
Exactly. The EBITDA margin is where they really separate themselves from the broader industrial cohort. For Q1, they posted an EBITDA margin of 52.4%.
Which is just wild.
It's wild. That metric is basically the cleanest proxy for the pure operating cash the core businesses are throwing off before you factor in, their specific capital structure and tax strategies.
Okay, but I have to challenge that number a bit.
Go for it.
Because Q1 is historically a seasonally weaker quarter for TransDigm. Fiscal Q1 typically doesn't blow the doors off the rest of the year. And furthermore, that 52.4% figure, it actually includes a 200 basis point dilution, so a 2% drag from their recent acquisitions. Companies like Simmons Precision Products and Servotronics.
Right, because newly acquired companies always drag down the average.
Exactly. When you bolt on newly acquired companies, they almost always have inferior margin profiles compared to the legacy portfolio, at least until the TransDigm integration playbook takes hold.
Yeah, that makes sense.
So if we are looking at a quarter that is typically slow and it's burdened with this 2% acquisition drag, how on earth did they manage to beat profitability expectations so aggressively? I mean, are they just starving the operating units of capital expenditure to artificially pump the margin?
That's a fair question, but management actually addressed the mechanics of that margin beat directly on the call, and stems from two very specific drivers, not underinvestment.
Okay, what's the first one?
The first driver is a favorable shift in their commercial OEM product mix. So while that 17% OEM growth you mentioned is strong, it actually came in a couple of points lighter than their own internal aggressive targets for the quarter.
Wait, they missed their own target?
Slightly, yeah. Mm-hmm. But because OEM components structurally carry lower margins than aftermarket components, selling slightly less OEM volume than anticipated meant the consolidated margin profile of the entire quarter skewed slightly higher.
Oh, I see.
Yeah, it's just a mathematical byproduct of their revenue mix.
Okay, so selling slightly less is the weighted average margin of the total sales pool.
Exactly.
It's sort of a counterintuitive dynamic, right? Where slightly missing a revenue ceiling actually boosts your profitability percentage.
Yeah, it's a funny quirk of their business model. But the second driver, and honestly the far more sustainable one, is their execution on cost structure optimization.
Tell me more about that.
So the decentralized nature of their 50-plus operating units means that individual management teams are heavily incentivized to execute on what TransDigm calls their value drivers.
Value drivers. Sounds very corporate.
It does, but it's very real for them. This involves incredibly clinical pricing strategies combined with aggressive, continuous productivity projects right on the factory floor.
Okay.
Mike Blissman, the CEO, highlighted that this base business margin improvement, so the organic margin expansion, was significantly stronger than they'd even modeled.
Oh, wow. So the local guys just did better than corporate thought they would.
Exactly. The local operators found efficiencies faster and deeper than corporate anticipated.
And when a business is operating with 52% margins on billions in revenue, I mean, it generates an absolute fire hose of free cash flow.
A fire hose is the right word.
Right. Q1 free cash flow landed just under $900 million, with operating cash flow over $830 million.
Which is a massive quarter.
It really is. Now, the CFO, Sarah Wynn, she did note that the timing of some interest and tax payments made this free cash flow conversion look a bit higher than a typical normalized quarter. But I mean, the net result is undeniable. They closed Q1 sitting on a cash mountain of over $2.5 billion.
And that $2.5 billion, that is the fuel for their core corporate strategy. They utilize the immense cash flow from their existing portfolio to aggressively finance the acquisition of new, under-optimized proprietary businesses.
The PE model in action.
Exactly. It's this continuous feedback loop of capital allocation. We'll definitely analyze their M&A machinery shortly,
Yeah.
as it's basically the most critical variable for the stock's future.
Yeah, we have to. But first, we can't evaluate the stock based solely on these consolidated headline numbers. For you, the listener, trying to determine if TDG warrants a position in your portfolio, we have to forensically examine why the underlying segments are moving the way they are.
Right, you got to look under the hood.
Especially because the global aerospace market in 2026 is complex. Management themselves characterize the current environment as bumpy. So let's dissect the story behind these numbers, starting with that massive 17% rebound in commercial OEM revenue.
So to accurately parse that 17% growth, we really have to zoom out and analyze the macroeconomic conditions of the commercial aerospace duopoly.
Boeing and Airbus.
Boeing and Airbus. Over the last 2 years, they have navigated incredibly turbulent production environments. Boeing specifically faced severe, highly publicized manufacturing disruptions, supply chain bottlenecks, and, regulatory scrutiny.
Yeah, it was constantly in the news.
Right. And all of that heavily constrained their 737 MX and 787 production rates throughout late 2024 and 2025. And when the apex manufacturer of the ecosystem halts or even drastically slows the final assembly line, well, the negative shockwaves propagate down to the entire supply chain.
That's the bullwhip effect in reverse.
Exactly.
If Boeing isn't rolling finished airframes out of the hangar in Seattle or Charleston, the massive network of suppliers feeding those assembly lines suddenly finds themselves overproducing against, non-existent immediate demand.
Yes, and TransDigm occupies a unique space in this ecosystem because they supply components to Tier 1, Tier 2, and Tier 3 manufacturers in addition to their direct-to-OEM sales.
Remind us how the tiers work.
Sure. So a Tier 1 supplier builds major integrated systems directly for Boeing. A Tier 2 supplies the Tier 1, and so on.
Got it.
So during the peak of Boeing's disruptions, those lower-tier suppliers didn't immediately halt their own purchasing. They continued ordering components from TransDigm at their historical run rates for several months.
Which means they just built up a huge pile of parts.
Exactly. It created a massive buildup of excess inventory in the channel. They were literally stacking parts on warehouse shelves while waiting for Boeing to resume normal cadence.
And eventually you run out of shelf space.
You do. And eventually those suppliers realized the bottleneck was prolonged and they entered a severe destocking cycle. They abruptly stopped placing new orders with TransDigm, and instead, they funded their own limited production by just burning through their accumulated safety stock.
Right, so it creates this sort of localized recession for the component manufacturer, even if the long-term demand for the final airplane remains perfectly intact.
Exactly.
But looking at this quarter's 17% jump, that localized recession appears to be, decisively over. We are seeing a really powerful snapback.
We are. The co-chief operating officer, Patrick Murphy, he was quite explicit on this point. Management believes the supply chain has largely processed that destocking phase.
Okay, that's good news.
It is. Both Airbus and Boeing are now demonstrating sustainable, albeit gradual, upward trajectories in their monthly build rates. And the fundamental end-user demand is just extraordinary right now.
Oh yeah, everybody is flying.
Global passenger traffic has fully normalized and is actively expanding. Airlines are desperate for next-generation, fuel-efficient capacity to manage their operating costs, and both OEMs possess these multi-year, record-breaking order backlogs.
Right, so with Boeing and Airbus increasing the velocity of the final assembly lines, TransDigm's Tier 2 and Tier 3 customers have finally depleted those excess inventory buffers.
Yes. They are now basically compelled to order components in direct lockstep with the accelerating OEM production rates.
It's a reversion to the mean, but the mean itself is shifting upward. Global takeoff and landing cycles are growing at roughly 4% year over year. The metal is flying, the airlines are profitable, and the primes are finally executing on their backlogs.
Exactly.
But I am looking at management's forward commentary, though, and they are not projecting a completely frictionless ramp up. They continue to use the word bumpy to describe the OEM production rate recovery, and they're actively building that volatility into their internal models.
Well, I think it's a necessary conservatism. The broader aerospace supply chain remains fragile, honestly. TransDigm might be executing flawlessly, but if a different Tier 1 supplier experiences a titanium shortage or a sudden labor strike or a failed quality audit, Boeing's final assembly line could face temporary localized halts again.
That's a great point. You're only as strong as the weakest link.
Exactly. So management is guiding for high single-digit to mid-teens % growth in OEM for the full fiscal year 2026.
That's a pretty widespread.
It is, but it intentionally accounts for the lingering, unpredictable friction across the broader industrial base.
Honestly, I actually prefer that cautious posturing. As an investor, you want a management team that underpromises and leaves room to overdeliver.
100%.
Particularly in a sector where a single negative headline about, a supplier defect can trigger algorithmic selling across the entire aerospace index.
Oh, we see it all the time.
Okay, let's pivot away from the OEM side and dig into the commercial aftermarket, because this is the segment that traditionally commands the highest multiples. It's the segment that generates the lion's share of the cash. It's the absolute golden goose for TDG.
The cash cow, for sure.
But when we look at the Q1 data, total commercial aftermarket only grew 7%. Transport aftermarket showed 8% growth, which was subsequently dragged down by a very sluggish business jet submarket that only managed 1% growth.
Yeah, that 7% aggregate figure, that was the most heavily scrutinized metric of the quarter.
Okay.
During the Q&A session, management made a very candid admission that just immediately dominated the analyst dialogue. They acknowledged that TransDigm's aftermarket growth is currently lagging the broader global aerospace aftermarket by a margin of 5 to 6 percentage points.
See, that is a massive red flag on its face. If industry analysts are modeling global aftermarket expansion at 12 or 13%, and TransDigm is only capturing 7%, the immediate visceral reaction for an investor is to assume structural degradation.
Right, like the thesis is breaking.
Exactly. Are they losing their pricing power? Are airlines successfully sourcing cheaper generic components? Is the proprietary moat finally being breached? We really have to unpack this lag mystery, because if the aftermarket franchise is deteriorating, the entire investment thesis just collapses.
Well, several analysts pressed management aggressively on that exact premise. And the response from the executive team broke that 5 to 6% differential down into two highly specific, quantifiable, and most importantly, temporary structural factors, rather than a loss of competitive positioning.
Okay, I am naturally skeptical when management teams explain away market share losses as, temporary structural factors. But let's look at the mechanics of their defense. What is the first factor?
The first factor is a pure revenue mix issue related to the engine aftermarket. So currently, the commercial aircraft engine sector is experiencing an unprecedented surge in maintenance demand.
Why is that?
Because modern next-generation engines operate at significantly higher temperatures and pressures to achieve their fuel efficiency targets. And this intense operating environment necessitates more frequent, highly complex, and exceptionally expensive overhaul cycles.
Ah, okay. The engines run hotter, so they break down faster.
Exactly. So the suppliers deeply entrenched in the hot section of the engine are posting explosive aftermarket growth numbers, and that is heavily skewing the industry average upward.
And let me guess, TransDigm doesn't do engines.
Correct. TransDigm is structurally underexposed to the engine sector. Their portfolio is heavily biased toward airframe components, interior systems, landing gear, flight controls, that sort of thing.
Okay, so mathematically, if the engine subsector is driving the blended industry average up to 13%, and TransDigm has minimal participation in that specific boom, they will inherently lag the headline average.
Exactly. Management estimates this engine mix dynamic accounts for approximately half of that 5 to 6% gap.
Okay, that is a mathematically sound explanation. If the broader market index is being pulled up by a sector you don't play in, your relative underperformance isn't indicative of losing ground in your specific verticals. It's just an artifact of the benchmark. I can accept the engine mix argument. What's the second reason for the lag?
The second reason revolves around channel inventory dynamics, which management consistently referred to as lumpiness.
Lumpiness. Gotta love corporate jargon.
Right. But here's what it means. TransDigm utilizes a vast network of third-party distributors to service the global airline aftermarket.
So they don't sell directly to the airlines?
Mostly no. Rather than transacting directly with hundreds of individual airlines for every single replacement valve, TransDigm sells in bulk to distributors. And those distributors hold the inventory and fulfill the immediate on-demand maintenance requirements of the airlines.
Okay, that makes sense for logistics.
But over the preceding 4 quarters, driven by higher interest rates and, frankly, a desire to optimize their own working capital, these distributors initiated a pronounced destocking cycle.
Ah, here we go again.
Yep. They deliberately chose to fulfill airline orders by drawing down their existing warehouse reserves rather than placing replenishment orders with TransDigm.
It is the exact same bullwhip inventory effect we just discussed in the OEM segment, but manifesting in the aftermarket distribution channel.
Precisely.
Distributors are trying to run leaner balance sheets, so they are intentionally shrinking their inventory footprints.
Correct. And CEO Mike Blissman quantified the impact, noting that this distributor destocking cost TransDigm approximately 1 to 2 percentage points of growth throughout the previous year. And that headwind persisted and perhaps even accelerated slightly into Q1 of 2026.
So the headline 7% growth reflects what TransDigm shipped into the channel, which was artificially depressed by the distributor's refusal to restock.
Exactly. However, there is a critical leading indicator here that completely neutralizes the bearish thesis, and it lies in the POS data.
POS data. This is the data point that matters most. Break down the POS mechanics for us.
Sure. So POS stands for point of sale. And in this context, it measures the actual volume of components the distributors are selling out of their warehouses directly to the end user airlines.
Okay, so what is leaving the distributor's building?
Right. And co-CEO Patrick Murphy explicitly highlighted that POS at their distributors grew at a double-digit percentage rate during the quarter.
Whoa. Okay, this is where the math becomes incredibly bullish. Let me get this straight. The distributors are selling components to the airlines at a double-digit growth rate, but they're only purchasing replenishment stock from TransDigm at a single-digit rate.
Exactly.
The delta between those two numbers represents the rapid depletion of the distributor's physical inventory. They are hollowing out their safety stock.
They are. The net inventory position within the distribution channel is contracting aggressively. And this is why investors cannot simply react to the headline 7% revenue growth.
Because eventually they have to buy more parts.
They have to. Distributors operate under strict service level agreements with the airlines. An airline will not tolerate a scenario where a multi-million-dollar asset is grounded an AOG, aircraft on ground situation, just because a distributor failed to stock a $5,000 electromechanical actuator.
Yeah, the airlines would lose their minds.
They would. So the distributor's inventory buffer has a hard floor. As they approach that floor, driven by that double-digit POS demand, they will be forced to aggressively re-engage with TransDigm. The replenishment orders will have to accelerate to match or even exceed the underlying airline demand.
This means the destocking headwind is inherently self-limiting. As we look toward the second half of fiscal 2026, the mathematical reality of empty warehouse shelves dictates that this lumpiness must flip into a massive restocking tailwind.
Management is forecasting exactly that inflection. They anticipate the distributor destocking will conclude and transition into a notable tailwind progressively from Q2 through Q4.
That's huge.
Furthermore, they directly confronted the fears regarding market share erosion. The executive team emphasized the rigorous, continuous monitoring of the aftermarket landscape for competitive displacement. And they reported zero material loss of market share to competing OEMs or to alternative solutions like USM used serviceable material or PMAs.
So the proprietary intellectual property moat surrounding their legacy portfolio remains entirely intact and unbreached.
Totally intact.
That specific confirmation is really the linchpin of the bullish thesis. The lag is a function of temporary inventory adjustments and engine market index skew, not a structural degradation of their pricing power or competitive dominance.
Right.
Okay, let's shift focus to the defense segment. In a portfolio heavily indexed to the cyclical nature of commercial aviation, defense acts as a crucial counterweight, doesn't it?
It does. It provides a baseline of highly predictable government-funded cash flow. Defense revenue was up approximately 7% for the quarter.
So the 7% revenue growth is solid, but I think the more compelling metric from a forward-looking perspective is the bookings data. Management indicated that defense bookings for Q1 were highly robust, showing strong year-over-year expansion. And crucially, they significantly outpaced the actual recognized sales for the period.
Yes. And in long-cycle defense contracting, bookings represent the leading edge of the revenue curve. Generating bookings at a faster velocity than sales translates directly into a growing backlog,
which mathematically secures future revenue visibility.
Exactly.
The defense procurement cycle is notoriously opaque, and executives often hide behind, vague platitudes about modernization trends or geopolitical tailwinds. So I really appreciate that Patrick Murphy provided highly specific, tangible examples of these bookings to ground the narrative.
The examples were great.
Yeah, he highlighted a multi-million-dollar contract awarded to their Shelton operating unit by Lockheed Martin. They will be supplying the latest generation VHF, UHF antenna systems for the C-130J aircraft.
And securing a proprietary position on the C-130 platform is just a masterclass in long-term cash flow generation.
Why is that platform so special?
Well, the C-130 Hercules is arguably the most successful military tactical transport aircraft in aviation history. It has been in continuous production in various iterations for over 6 decades, and the J model represents the modern standard.
Okay.
By locking their specialized antenna technology into the baseline production of the C-130J, TransDigm guarantees a steady stream of inaugural OEM revenue, followed by decades of locked-in aftermarket replacement revenue as these airframes are deployed globally by the U.S. and allied militaries.
Once again, locking in that recurring revenue. And the second contract example is arguably more illustrative of their strategic niche. Their Irvin GQ business secured a $24 million contract from the U.S. Department of Defense to manufacture floating decoy systems designed to protect the U.S. Navy's fleet of Arleigh Burke-class guided missile destroyers.
Yeah, this specific contract perfectly encapsulates the ideal TransDigm defense product. Think about it. An Arleigh Burke destroyer is a multi-billion-dollar capital asset. When it operates in contested environments, it faces the asymmetric threat of highly sophisticated anti-ship cruise missiles. The floating decoy system acts as a critical last-line physical countermeasure. It's designed to deploy and emit electronic or radar signatures that confuse and divert the incoming munition away from the ship.
And what makes this so lucrative from a business model perspective is the fundamental nature of a decoy, right? It is not a durable piece of capital equipment. It is a consumable.
Yes.
If a destroyer deploys the decoy, it is expended. It is either destroyed by the incoming missile or just abandoned in the ocean. The Navy is forced to immediately procure a replacement to maintain the ship's defensive readiness. They have to stock these consumable countermeasures in depth across every single destroyer in the active fleet.
It's the perfect razor blade. The contract deliveries commence in fiscal 2026 and are scheduled to run over a 4-year period. It is a highly specialized, deeply proprietary, consumable product that is absolutely non-negotiable for national security.
It's the ultimate manifestation of the toll booth model applied to the defense sector. They aren't attempting to bid against General Dynamics or Huntington Ingalls to build the entire multi-billion-dollar hull. They are cornering the market on the singular, highly specialized, consumable component that the hull absolutely requires to survive in a combat theater.
Brilliantly put.
Okay, so we have established the operational reality of the base business. The commercial OEM segment is experiencing a structural snapback. The commercial aftermarket is positioned for an aggressive restocking tailwind as distributor inventories hit rock bottom. The defense segment is building a massive backlog of proprietary consumable technology.
All cylinders firing.
Right. All 3 of these engines are running simultaneously, generating that incredible $900 million in quarterly free cash flow. But generating cash is only half of the equation, isn't it?
It is. Because of TransDigm's aggressive, highly leveraged capital structure, the entire trajectory of their enterprise value depends on how surgically they deploy that $2.5 billion cash pile. We have to follow the money.
Which brings us to the core of their future growth strategy: management guidance and the execution of their M&A machine.
Let's talk about the M&A.
TransDigm's approach to capital allocation is famously aggressive. They do not hoard cash on the balance sheet for the sake of conservative liquidity ratios. They view undeployed cash as a drag on equity returns. And in a breathtakingly compressed window of just 5 weeks, they executed binding agreements to deploy over $3.1 billion across 3 massive acquisitions.
The velocity of this capital deployment is just staggering.
It really is. On December 31st, they announced the acquisition of Stellent Systems for approximately $960 million in cash. Stellent is a manufacturer of high-power electronic components tailored for aerospace and defense applications, bringing in roughly $300 million in calendar 2025 estimated revenue.
Okay, that's a solid add.
But then, barely 2 weeks later, on January 16th, they dropped a massive $2.2 billion cash bid to acquire 2 deeply integrated companies, Jet Parts Engineering and Victor Sierra Aviation. These 2 entities are projected to generate about $280 million in calendar 2025 revenue.
And the acquisition of Jet Parts Engineering and Victor Sierra is, hands down, the most strategically significant move they have made in years. It totally dominated the strategic discussions during the analyst Q&A.
Why is that one so special?
To grasp the implications of this $2.2 billion deployment, we must clearly define the competitive dynamics of PMAs within the aerospace supply chain. PMA stands for Parts Manufacturer Approval.
Okay, let me frame this for the listener because the mechanics of PMAs are crucial. Historically, TransDigm's entire multi-billion-dollar valuation has been built on an impenetrable moat of proprietary intellectual property. They own the exclusive rights to the original name brand designs. Let's say they design a highly specialized hydraulic valve for the Boeing 737. TransDigm owns that blueprint.
Right, and they protect it fiercely.
Exactly. So a PMA manufacturer operates by looking at that lucrative aftermarket and deciding to reverse engineer the component. They design a replacement valve from scratch, subject it to punishing, exhaustive testing protocols, and prove to the Federal Aviation Administration that their newly designed part meets or exceeds every single safety, durability, and performance metric of the original TransDigm valve.
Which is not an easy process.
No, it's brutal. But once the FAA signs off, they are granted a PMA. They possess the legal and regulatory authority to manufacture and market that replacement part directly to the airlines, completely bypassing the original OEM.
PMAs function identically to generic pharmaceuticals in the healthcare sector.
Oh, like buying generic Advil instead of name brand?
Exactly. They introduce intense direct competition into previously monopolistic aftermarket verticals. Airlines aggressively pursue PMA adoption because, much like generic drugs, PMAs are typically offered at a substantial discount compared to the exorbitant pricing of the original proprietary component. It provides the airlines with critical leverage to drive down their exorbitant maintenance and operating costs.
Given that dynamic, PMAs basically represent the singular existential threat to TransDigm's core pricing power. TransDigm has spent decades aggressively defending their IP and viewing PMA manufacturers as hostile insurgents trying to commoditize their high-margin toll booths.
Which is why the market was so shocked.
Right. So when TransDigm suddenly pivots and drops $2.2 billion to acquire Jet Parts Engineering, and Victor Sierra, two of the most sophisticated, high-volume PMA developers in the industry, it fundamentally shocked the analyst community.
The strategic intent behind the acquisition was immediately questioned. Scott Mikus, an analyst from Melius Research, confronted the CEO directly regarding the underlying rationale. He essentially asked if this was a purely defensive, retaliatory maneuver.
Like buying the enemy to silence them.
Yeah, or was TransDigm acquiring these PMA capabilities to establish a deterrent? The implication being, if a competitor successfully reverse engineers a TransDigm component, TransDigm could now utilize Jet Parts Engineering to immediately target and reverse engineer the competitor's most profitable legacy parts in retaliation.
Wow, it sounds like mutually assured destruction applied to aerospace IP.
It does. But CEO Mike Blissman completely rejected that narrative. He didn't obfuscate with corporate synergies. He was brutally pragmatic.
What did he say?
He explicitly stated that they did not execute a $2.2 billion transaction for defensive posturing, retaliation, or theoretical cross-selling synergies. They acquired these businesses for one singular reason. They analyzed the cash flow projections and determined they could generate a 20% internal rate of return.
Wow, just pure math.
Pure math. That 20% IRR is the absolute gravitational center of TransDigm's capital allocation philosophy. Returning to our initial analogy, this is exactly how a top-tier private equity firm operates. A PE firm establishes a rigid hurdle rate, a minimum acceptable annualized return on invested capital.
And for TransDigm, that's 20%.
Yes. For TransDigm, that historical benchmark demands returns in the 20% echelon. They deploy an army of analysts to model out the cash flows of a target acquisition over a 5 to 10-year horizon. If their proprietary integration playbook, which involves surgical cost reductions, optimized pricing architecture, and lean manufacturing principles, if that can mathematically guarantee a 20% return on the cash deployed, they execute the deal.
They just don't care about the optics.
Not at all. They are completely agnostic regarding the specific product taxonomy. Yeah. It is irrelevant whether the asset is a legacy proprietary OEM component or a generic PMA replacement. If the financial architecture supports a 20% IRR, it fits the portfolio.
Plus, management elaborated on the macroeconomic trends driving that calculation, right? PMAs currently represent a small fraction of the total commercial aerospace aftermarket, but they are expanding at a velocity that significantly outpaces the broader industry.
Oh, yeah. Airlines are basically begging for them.
Airlines are facing relentless pressure to optimize their cost per available seat mile, and PMA adoption is a primary lever to achieve that. TransDigm already possessed marginal exposure to the PMA space through several legacy operating units, but deploying $2.2 billion for jet parts elevates them instantly to a position of market dominance.
It really does.
They identified a secular growth vector, recognized that jet parts possesses a highly refined engineering engine capable of continuously churning out new FAA certifications, and essentially bought the apex predator in the space.
But the integration strategy for these new assets is equally fascinating and highly counterintuitive to traditional corporate M&A. Well, when questioned about potential synergies specifically, whether they intended to force jet parts to distribute PMAs through TransDigm's existing massive global network, the CEO essentially laughed off the concept. They will rigidly adhere to their decentralized operating model.
Wait, they aren't going to combine sales forces?
Nope. Jet Parts Engineering and Victor Sierra will not be absorbed into a monolithic corporate structure. They will remain completely autonomous. Their existing management teams will be left largely intact, insulated from corporate bureaucracy, and tasked exclusively with hitting their localized financial and operational value drivers.
I want to push back on that a bit, because if you aren't integrating the sales forces or consolidating the supply chains to extract massive synergies, how do you justify the premium valuation they undoubtedly paid? Another analyst pushed them on the margin profile. TransDigm operates at a 52% margin. Generic PMAs typically operate at a lower margin because their primary value proposition to the airline is a discounted price. Did management underwrite this $2.2 billion deal on the assumption that they can magically force jet parts to achieve a 50% margin?
They absolutely did not, and that is a testament to the discipline of their capital allocation model. Management explicitly stated that they modeled the 20% IRR based on realistic conservative margin assumptions that reflects the inherent economics of the PMA business.
So they aren't planning to jack up the prices.
Right. The explosive value creation in the PMA model is driven by sheer volume and market penetration, capturing a larger share of the total replacement cycles from the airlines, not by artificially inflating the profit margin of a product designed specifically to be the low-cost alternative. They are not relying on aggressive, unrealistic margin expansion to justify the purchase price. They are relying on the proven, compounding volume growth of the jet parts engineering engine.
That is fascinating. Okay, let's call back and look at the aggregate balance sheet, because this is where the retail investor needs to pay close attention. TransDigm just committed $3.1 billion in cash to M&A within 5 weeks. Simultaneously, they opportunistically executed $100 million in share repurchases, capitalizing on a brief dip in their stock price during Q1.
They're not shy about spending money.
They are deploying capital with incredible aggression. For a standard industrial company, spending billions in cash while operating with high leverage would trigger immediate downgrades from credit rating agencies. We need to dissect their debt structure. How highly leveraged are they, and what are the systemic risks?
So TransDigm's capital structure is entirely intentional and highly engineered. It is the defining feature of their private equity replication strategy. They deliberately utilize significant leverage to amplify the returns on equity for their shareholders. Currently, their net debt to EBITDA ratio stands at 5.7x.
Okay, to clarify that metric for everyone, for every single dollar of pure operating cash flow or EBITDA the company generates, they carry $5.7 of debt on the balance sheet. In traditional corporate finance textbooks, a leverage ratio of 3x or 4x is generally considered the ceiling for prudent industrial management. A 5.7x ratio sounds dangerously over-leveraged on the surface.
It appears elevated relative to conservative peers, for sure. But context is critical here. That 5.7x figure actually represents a sequential deleveraging from 5.8x in the preceding quarter. More importantly, TransDigm's board of directors has established a rigid target operating range for leverage, sitting between 5.0x and 7.0x.
Ah, so they are right in the sweet spot.
That's exactly. Therefore, at 5.7x, they are operating perfectly within the lower half of their mandated comfort zone. The entire enterprise, their cash generation predictability, their cost structure, their M&A cadence is optimized to function flawlessly at this exact degree of leverage. It is not an accident. It is the design.
But the macroeconomic environment has shifted radically over the last 3 years. We are no longer in a zero interest rate phenomenon. We are navigating a higher for longer interest rate regime dictated by the Federal Reserve. TransDigm carries approximately $30 billion in gross debt on their balance sheet. If that debt is exposed to floating interest rates, the sheer magnitude of the interest payments could hypothetically consume their entire free cash flow generation. How are they mitigating that existential rate risk?
The CFO, Sarah Wynn, spent considerable time delineating their risk mitigation architecture. The primary defense mechanism is aggressive maturity management. They do not have a massive concentrated wall of debt maturing in the near term that would force them into a punitive refinancing environment. Crucially, she highlighted the most important statistic regarding their balance sheet. Approximately 75% of that massive $30 billion debt load is functionally locked into fixed interest rates through fiscal year 2029.
The mechanics of how they achieve that fixed rate are complex, as much of their original financing is typically structured as floating rate institutional term loans.
Right, they have to actively manage that.
They do. They actively construct this 75% fixed position through a sophisticated portfolio of financial derivatives, specifically interest rate swaps, caps, and collars. They negotiate with major investment banks, paying a premium to enter into swap contracts that effectively trade their volatile floating rate obligations for a guaranteed fixed rate.
It's basically an insurance policy.
Exactly. They are essentially buying insurance policies that cap their maximum interest exposure, regardless of how aggressively the Federal Reserve might hike the underlying SOFR rates. By locking down 75% of the portfolio through 2029, they have successfully insulated the core cash flow engine from immediate macroeconomic volatility. They have bought themselves half a decade of absolute financial predictability.
And that predictability translates directly into their ability to service the remaining obligations. The ultimate stress test for a highly leveraged balance sheet is the EBITDA to interest coverage ratio, the measure of how many times over the company's operating cash flow can satisfy its annual interest expense. TransDigm ended the quarter with a highly comfortable coverage ratio of 3.1x.
And what's their internal requirement for that?
Their internal risk management framework demands a minimum coverage ratio between 2.0x and 3.0x. Therefore, despite the $30 billion in gross debt, they are currently operating with a safety cushion that actually exceeds their own stringent internal requirements.
The synthesis of this capital structure analysis leads to a staggering conclusion for the forward trajectory of the company. Because their cash generation is so immense and their leverage ratios are so meticulously managed, management confirmed that even after fully funding the $3.1 billion in acquisitions for Stellent, Jet Parts, and Victor Sierra, they still possess nearly $10 billion in available M&A firepower.
$10 billion in dry powder.
It's unbelievable.
They can deploy that capital either through accumulated cash reserves or by issuing new debt within their 5x to 7x parameters without violating any of their internal risk covenants. The M&A machine is not exhausted. It is fully primed and actively scanning the horizon for the next multi-billion-dollar target.
Which perfectly transitions us into the final component of the narrative, the fiscal year 2026 guidance. They didn't simply report a massive historical quarter and rest on their laurels. They fundamentally upgraded their financial trajectory for the remainder of the year.
They did. Management proactively raised their full year 2026 guidance across every major metric, and it is absolutely vital to emphasize that this upgraded guidance completely excludes the anticipated financial contributions from Stellent, Jet Parts, and Victor Sierra, as those transactions have not officially closed and cleared regulatory hurdles.
Oh, wow. So this is just the base business.
Yes. This upward revision is predicated entirely on the accelerating performance of the existing legacy portfolio.
The data really dictates the narrative here. The revised midpoint for full-year sales guidance now sits at $9.94 billion, representing a robust 13% expansion over the previous fiscal year. Correspondingly, the EBITDA midpoint guidance was aggressively elevated to $5.21 billion, also reflecting a 13% year-over-year increase. Their projection for normalized free cash flow remains anchored at an immense $2.4 billion for the year.
The critical analytical question is identifying the catalyst for this upgraded outlook. Did management detect a sudden, unforecasted acceleration in the global aerospace recovery? According to the CEO, absolutely not. The underlying macroeconomic assumptions regarding end-market channel growth remain entirely static. They are still modeling OEM growth in the high single to mid-teens, commercial aftermarket growth in the high single digits, and defense growth in the mid to high single digits. The external environment hasn't materially shifted in their models. If the external market assumptions remain unchanged, the entire guidance raise must be a function of superior internal execution. Precisely. The upward revision is a direct reflection of the operating units executing their value drivers with greater velocity than anticipated. They are extracting deeper cost savings, optimizing pricing architectures more effectively, and driving higher productivity yields on the factory floors. They are systematically generating more pure profit out of the exact same macroeconomic conditions they modeled 3 months ago. And Historically consistent with TransDigm's communication strategy, the CEO offered subtle commentary, suggesting that even this newly elevated guidance likely contains a layer of strategic conservatism. They structurally prefer to establish a financial bar they possess high confidence in clearing.
Always underpromise and overdeliver. We have dissected an immense volume of data today. We analyzed the private equity toll booth model, the staggering 52.4% EBITDA margins, the mechanics of the 17% OEM snapback, the temporary nature of the aftermarket destocking cycle, the strategic brilliance of the defense bookings, the sheer scale of the $3.1 billion M&A offensive into the PMA sector, the sophisticated engineering of their $30 billion debt stack, and the upgraded internal guidance.
It's a lot to process.
It is time to synthesize this data into an actionable conclusion. Let's move to our outro and answer the fundamental talk stickers question.
What is the definitive bottom line for the retail investor currently holding or evaluating TDG for their portfolio?
Based on the exhaustive data we just analyzed, we have to take a definitive, opinionated stance. What is our verdict on this quarter?
The verdict is unequivocal. This was a profoundly and structurally bullish quarter for TransDigm Group.
I am in complete agreement. The bullishness is amplified when you contextualize the results against the sheer volume of friction they encountered. This was not a quarter characterized by effortless macroeconomic tailwinds. They navigated a highly volatile, completely unpredictable commercial aircraft production recovery crippled by Boeing's ongoing supply chain paralysis. They faced an aggressive, cash-preserving destocking cycle from their primary aftermarket distributors. Furthermore, they were forced to absorb a mathematical 200 basis point penalty to their consolidated profit margins simply as the cost of integrating previously acquired, under-optimized businesses.
In a traditional industrial conglomerate, any one of those three friction points could serve as the primary justification for a missed quarter and a downward revision in guidance.
Yet, despite that concentrated friction, TransDigm aggressively over-delivered on their profitability metrics. They drove organic growth north of 7%, captured a 17% surge in OEM revenue, and delivered a 52.4% EBITDA margin. They generated nearly $1 billion in free cash flow in a single 90-day window, and rather than holding it, they instantly synthesized that capital into $3.1 billion worth of high IRR acquisitions to systematically corner the rapidly expanding PMA market.
It's a machine.
The toll booth is not merely operational. They're simultaneously adding new lanes, continuously raising the toll rates, and ruthlessly engineering the operating costs of the booth itself down to the absolute floor.
For the listener actively managing a position in TDG, here's the actionable framework you need to adopt. It is imperative that you insulate your investment thesis from the daily sensationalism of the aerospace news cycle. The broader financial media will continuously broadcast headlines regarding Boeing factory audits, Airbus delivery delays, localized labor strikes, or titanium sourcing bottlenecks.
Noise. It's all noise.
Exactly. You must recognize that these events represent short-term cyclical turbulence. They do not fundamentally alter the long-term trajectory of global air travel or the inevitable aging of the existing global fleet. TransDigm's true enterprise value is derived from its unassailable aftermarket pricing power, the defensive moat of its proprietary IP, and its highly systematized M&A integration playbook.
To maintain a rigorous evaluation of the stock moving forward, what are the specific localized metrics investors should be monitoring in the upcoming Q2 and Q3 earnings reports?
The absolute priority is tracking the execution of their margin integration. Specifically, when the massive transactions for Jet Parts Engineering, Victor Sierra, and Stellent Systems officially close and hit the consolidated balance sheet, you need to measure the immediate dilution to that golden 52.4% EBITDA margin.
Right, because we know those new companies operate at a lower margin initially.
Exactly. Does the drag exceed the historical 200 basis point norm? More critically, you must monitor the velocity at which the TransDigm decentralized operating model can rationalize the cost structures of those new entities and pull their localized margins upward. Rapid margin optimization is the definitive proof that the private equity integration machine remains fully functional.
And what's the secondary metric that dictates the health of the core organic business?
You must closely track the resolution of the aftermarket lumpiness. The management team explicitly highlighted the double-digit POS growth occurring at the distributor level. Mathematically, that POS velocity guarantees that a massive restocking cycle is imminent.
So we want to see those orders finally hit TransDigm's books.
We need to see empirical evidence in Q2 and Q3. that the destocking headwind has definitively flipped into a revenue tailwind as distributor warehouse inventories hit critical depletion levels. If you see commercial aftermarket revenue growth suddenly accelerate from this quarter's 7% back into the mid-teens, matching or exceeding the broader global market index, that is the ultimate confirmation that the core cash engine is firing on every single cylinder without constraint.
We have delivered the verdict, and we have outlined the actionable metrics. But I want to leave you, the listener, with a final provocative thought to evaluate on your own. It is a structural question that wasn't explicitly debated on this earnings call, but it represents the logical, inevitable conclusion of everything we have discussed regarding their massive scale.
Let's outline the dilemma.
TransDigm has definitively proven over multiple decades that they possess a flawless, repeatable formula. They identify a $200 million mom-and-pop aerospace manufacturer operating with bloated costs and suboptimal pricing. They acquire it, plug it into their decentralized network, aggressively optimize the cost structure, enforce clinical pricing strategies, and consistently generate a private equity tier 20% return on invested capital.
It is brilliant.
However, due to the compounding success of that exact formula, they are now an enterprise valued in the tens of billions of dollars. And as the CFO explicitly stated, they are currently sitting on $10 billion in M&A firepower, fully loaded and ready to deploy.
$10 billion is an astronomical sum of capital to allocate effectively in a highly consolidated niche industrial sector.
That is the core of the dilemma. How long can an enterprise of this magnitude continue to source and execute enough of these highly specific $300 million proprietary component acquisitions to materially move the needle on a $100 billion valuation? There's a finite universe of under-optimized proprietary aerospace valve manufacturers in existence.
They're going to run out of targets.
Eventually, the sheer gravitational mass of their own compounding cash generation might force management to hunt significantly larger, exponentially riskier game. If TransDigm is fundamentally forced by its own scale to attempt the acquisition of a massive, multi-billion-dollar integrated Tier 1 conglomerate just to maintain their required growth trajectory, can they successfully apply that same ruthless, decentralized optimization playbook? Or does the magic of the toll booth formula inherently fracture when applied at that massive, highly integrated scale?
It is the ultimate manifestation of the innovator's dilemma, applied directly to capital allocation strategy. Can they scale the magic indefinitely without breaking the machine? That is the paramount overarching question every long-term shareholder must constantly evaluate.
It truly is the defining challenge of their next decade. So to bring this entire analysis back down to earth, the next time you are sitting in the window seat of a commercial flight, watching the wing flaps precisely adjust and listening to the high bypass turbofans hum, do not merely perceive a single unified machine built by a single corporate entity. Look closer. See the thousands of hidden, highly engineered toll booths scattered across that airframe. Understand the proprietary intellectual property moats, recognize the fierce, unavoidable economics of the aftermarket replacement cycle, and appreciate the invisible, deeply leveraged web of capital allocation that guarantees those specific components are manufactured, certified, and delivered at a staggering 52.4% profit margin. It brings absolute clarity to the otherwise diagnostic muddy waters of aerospace finance. Thanks for taking the deep dive with us.